Hey, good evening, everyone. So I'm going to get this kicked off here. Um, don't really have too much to discuss other than I'm just going to be updating some stuff on my spreadsheets here, and you guys can follow along with me, and I'll kind of talk through it and add another column here, so that way I can kind of go through it, and then by the time I'm done that, I'm sure you guys will have some questions and what have you. So I'm just going to add a few rows here so I can basically just copy and paste some values and from like up top here. And then basically, I don't show you guys really this ever, but add my M1 Finance. So that way I have that on here as well. Because on Tuesday I bought some Johnson & Johnson and some 3M, and this obviously is Johnson & Johnson. And I am working on something that would help automate this. There's a couple apps out there. Google Spreadsheets is one, and then there's a few others that actually automate some of the. Oh, you guys are probably still looking at me. Sorry, my bad. Actually, automate the process of this, or the majority of this portfolio. So it would make it a little bit simpler, and I would probably add that for you guys, so that way it's something a little bit easier. So it's probably going to be something I experiment with over the coming weeks, and as I see fit, I will, either if I like it, I'll share it with you guys. If I don't like it, I'll kind of make a video about why. It's a couple pretty reputable companies, so it would be good. I'm surprised I don't see more videos about it, I guess, on the internets. So those of you that are familiar, about, what was it, Friday, I basically finally invested in my M1 Finance account, and didn't realize, but it would take over the weekend until the shares actually executed. So finally went through on Tuesday. We can kind of look through this now and actually go through the M1 Finance piece. Yeah, you can see the portfolio here. Went through about $5,500 as the cost basis or so, and got myself about 17 shares of 3M and about 21 shares of Johnson & Johnson. And so with that, we will be adding to L portfolio, so that way we can keep track of it. And then we'll also add the dividend amount to the portfolio, so we can see what the forward income is. I'm hoping I'll get close to $900 a month in dividend income. It's getting really close, really close. So cost basis was $27.50 divided by whatever this is. And same with this. So that's not right. Oh, did I switch around the shares? Whoops. Yes, I did. My bad, folks. Okay, so I ended up with 21.44583 of Johnson & Johnson here. So what is that going to add me in terms of total dividend income? So it's about $180. That's pretty good. Not going to complain. I'm not going to add the price per share now because I really don't care. But what I care more about is the dividend income. So let me add another row here so I can add my total line and call it a day. So average, that's not true. Oh, that didn't do anything. That's not true either. So this goes to 102, so from 101 to 102. Let's add this over here. And this is a percentage. So they offset each other at the moment, basically. So then yield on cost. Yeah, sounds about right. So adding this to the portfolio is about 3.3% yield, which is pretty good. Not gonna complain with that guy. But let's check over at the live stream to see if anybody's actually on here. What's up, everyone? How's everyone doing? $10 a month, man. That's you gotta start somewhere, man. Netflix bill, yeah, that's the way to look at it. That's awesome. That's awesome. Yeah, a lot of people don't look at it. They say, "Oh man, $10, that's nothing. That's nothing." But you start somewhere. I started at $10, and I committed, and this is where I'm at now. Not saying I'm the be all end all or anything like that, but $10 is where you got to start. Everyone starts there. So where did I actually end up putting this? It's right below my computer shares. Where is it? I lost it. Individual brokerage account. M1 Finance. Cool. So dividends received, and it is right below. It's right above computer shares. So we'll add it in here. So this is the fun part, man. I'm hoping I can automate this a little bit more to make it even more fun, but even still, this is fun. You get to take your dividends and invest them, and it's a lot of fun. So I probably have missed out on both Johnson & Johnson and 3M for the rest of the third quarter, but fourth quarter should be good. So we'll do that. And then we can add it for next year, which is the fun part. So let's make this J&J. Let's make this 3M. And so what we're going to do, go to the portfolio, go to the yearly, divide by 4. And just click, drag down. Awesome. We can do that. And that'll increase this December to $1,100. It's pretty good. Can't complain with that, just for dividends. And then if we go down to 2020, which is the real money maker here, and do the same. Oops. Be good for $180 next year, which is A class. And that's not even including the dividends that it's going to reinvest by the end of this year, so might be closer to $195 next year. Oops. Let's copy this format here. And then we'll copy this bad boy. Yeah. So what else is I got to say? So relatively interesting week. Got paid a crap ton of dividends on the first, which was awesome. Can't complain with that. Not at all. And so yeah, that's basically that. I mean, I don't know what else I can say other than feels good. But got $111 from Wells Fargo, and yeah, that's about it. Okay, so actually looking at, I wonder if that automatically will add to the sector. I don't remember if it's that good. It's not that good. Okay, so I gotta add it to the sector. Consumer discretionary. It's not in there though. It should be. Or is it just not as good as I thought it was going to be? Did everything go up? It didn't. Oops. Nah, I guess I'm too lazy. I can fix it later as always. But it's working on here, so 10,700, divide that by 12. Very close. Very close. 892. So averaging about 4%. So what's 900 minus this? So I'm $7 away. Divide that by 0.04. So I need to invest $180. That's it. Had I only invested $180 more, next year will be $900 a month. Well, that's frustrating. Okay, let's go back to people. How are you guys doing? So let's see. I don't like this view. Can I do... There you go. I like this view. So what's going on, guys? Oh, you're going to bed already? It's only 8:47 in Barbados, man. So anyway, how are you guys doing? Any questions for me? Feel free to let me know. That's basically it at the moment. I was trying to think what else there is. Think about. So I did some analytics. So I don't remember when I made the actual dividend spreadsheet available for download or purchase. When was that? Sometime last month, sometime in August. And 35 of you have bought it so far, so thank you. I really appreciate that. It's awesome. It means a lot. And that's going to be something that I continue to try to work on. Like I mentioned, for some of you that are just getting on the live stream now, it's not automated at the moment, and that's one of the goals, is to make it automated, because obviously, as you can see, as I just demonstrated, it's a little bit difficult. It's not difficult, but it's time consuming, and there's got to be a better way, yeah? So if I'm able to do that, then I feel like it would be a lot more useful of a product for you guys, and I would obviously put that on the Shopify store as well for you guys to download. Buzzlight, so yes, I'm more than happy to discuss Cardone Realty and how it's doing and talk about how it works. At the moment, I've only received the one payment, so it'd be a rather, and it was not a light payment per se. It was still, on average 4.5% to 5% if you were to annualize it from a cash flow perspective, which is pretty good. And it does come with depreciation, so I'm also really curious how that's going to work at the end of the year as well, because it is a partnership, I actually do get a portion of the depreciation at the end of the year. So I'm curious how that's going to work as well, because as you know, real estate, you can depreciate over time. But the fund wasn't fully invested yet. So some of the fund was still waiting to invest in other properties. And I believe since I've invested with them, they've invested in about 2 or 3 other properties for Cardone Equity 4 and 5. And so I'm curious. I'm not guaranteeing, obviously, because I can't, but I believe that this month's payment might be a little bit bigger, and next month's payment might be a little bit bigger as well, because the fund is now fully invested. And I believe they're closed out. I'm not 100%. If not, they're very close to being closed out. So yeah. Oh man, Gen X is the spreadsheet king, huh? I thought I was the spreadsheet king. What were your buys with the first of the month's dividend paid? The buys were actually just reinvesting the dividends. I think I stopped. I think some of you guys may know I stopped reinvesting all my energy dividends because they're such a large portion of the portfolio that I was afraid that it would continue to be overbalanced. So if you were to actually look at the sector allocation of the portfolio, Many of you guys know this, and of course it would actually continue to go down a little bit because the portfolio now includes some other things like healthcare and what have you, but it's not necessarily reading. Womp womp. I feel like I have so much more than this invested in healthcare. I'll have to figure it out. But anyway, as you can see, the big large green pie is the energy portion of the portfolio. So on the right, it's the income. So about 30% of the income. Wow, it's below 30%. That's awesome. So just below 30% of the income from the portfolio comes from energy stocks, whether that's pipelines, oil and gas. I think that's mostly it. And there's some other stocks in there as well. A lot of it comes from energy, yeah. And so trying to take that money and invest it elsewhere to try to even out the portfolio a little bit, because I believe at the moment that some of them not struggling per se, but they pay a pretty healthy dividend, and I think spreading that risk around to other companies that pay a little bit less of a dividend and have a little bit more secure of a free cash flow position might be beneficial. And then what you can see on the left is the actual value amount. So 24% of the portfolio is in energy stocks, 30% of it is income. 30% of the income of the portfolio comes from energy stocks. So very, very interesting way to look at things. At least from my perspective, it allows me to try to understand and try to get things like industrials and healthcare into a better position. And both 3M and J&J are industrials and healthcare, respectively. So obviously 3M is industrials and J&J is healthcare. So that is that. So going back to some of the questions here. Yeah, you said I could pop this out, so maybe I will. So that way see, this is why they pay the big bucks. So what kind of analysis you get into when picking a long-term stock for your portfolio? That's a really good question. I thought you were going to bed, dude. What? First you said goodnight from Barbados, and then anyway, I'm just messing with you. But so actually looking at the long-term stock and what actually I purchased. So it really varies by what I'm investing in, yeah. So if you're investing in a real estate investment trust, price to earnings ratio doesn't work, yeah, because earnings can be heavily manipulated, and this goes for all stocks, for everybody. So I guess listen up. And I think I may have explained this before, but I don't think this really hits home for a lot of people. I think a lot of people look at price to earnings ratio, and I think it is a somewhat important criteria, but for certain things like companies that invest a lot of capital into depreciating assets like factories or refineries or pipelines or things that are railroads, things that are very, very extremely capital intensive, companies get to write that off on their earnings, yeah, because earnings are what people are getting taxed against. And so if these companies have such a large capital outlay to maintain things like railroads, factories, what have you, they're going to write it off against their earnings so that way they don't have to pay as much in taxes. Otherwise, they're going to pay a larger tax bill. So earnings sometimes get deflated. And so people might be like, oh my God, this oil company only made, $3 billion or what have you. They're like, why wouldn't you just invest in something like Google? Or Google is a lot less of a capital intensive business. Yeah, they do have capital associated with it, and they do spend a lot of capital, but comparatively to oil and gas companies and things that you can, or pipeline businesses or railroad businesses, or BHP, for example, I feel like the capital from those organizations are have a lot larger of an ability to depreciate. Am I 100% certain on that? No, because I'm not an accountant, but anyway, that will detract from the earnings that is in the P over E, or price to earnings ratio. So that would potentially inflate the price to earnings ratio, yeah, because you have a smaller you have a smaller denominator, but the numerator might stay the same because the price of the stock might not have changed. So I think a better thing to look at is price to cash flow, personally. And an even better thing to look at is price to free cash flow, but that's a different story for a different day. So if you're looking at like a company's price to earnings before interest and taxes and depreciation, that's kind of what's actually coming into the company's register, yeah? So I'll type it EBITDA. And different companies, do different things here, but this is basically what's hitting your cash register, right? The EBITDA, earnings before interest, taxes, depreciation, and amortization. So this is basically saying like a non-manipulated value. And other companies call this cash flow from operations or what have you. So when you're looking at real estate is something that's very capital intensive as well, yeah? And you get to depreciate every piece of real estate, at least in the United States, about 3.5% of it a year. So if you have $100,000 worth of real estate, you get to write off $3,500 of that every single year. So that being said, earnings from, say, Realty Income Corp might actually be negative, or Stag Industrial might be negative, but in actuality, the companies are making money. Yeah, it's just the fact that they're being able to write off a lot of that stuff on their taxes. So price to EBITDA or price to cash flow from operations, I think for any company is probably what you want to look at. And then obviously one-off things like taxes, like when Trump did the big tax cuts, a lot of companies had massive earnings because they were able to write off or write back a bunch of taxes that they had cut off for earlier in the year, or earlier in the first two quarters. And I believe it happened in 3Q or 4Q. And so companies were able to write back those things that they had written off earlier in the year into their earnings. So the fourth quarter earnings in 2017 were like massive for most companies. So anyway, and that was all due to taxes there. But another thing I also look at is specifically for dividends. I think a lot of people look at payout ratio, this normal payout ratio. And payout ratio is the same thing. Yeah, a lot of people look at earnings. Yeah, earnings is important. I'm not going to get it, try to deviate you from that. But once again, that also has the depreciation and amortization piece in it. So companies that have a lot of depreciated assets like railroads, what have you, those earnings are going to be deflated. But then you're looking at the payout ratio. So some companies, per se, might have a payout ratio of over 100%, and they're not necessarily in danger of cutting the dividend. Of course, you might want it to be a little bit less than that, but a payout ratio to free cash flow is probably a better thing to look at. So price to FCF or price to cash flow is probably something better, because if your price to free cash flow ratio, your dividend, total dividend divided by your free cash flow, total dividend divided by your cash flow, if both of these are over 100%, then you're really in trouble. Yeah, so that means the company's taking in X amount and they can't even pay that off, because then they have to go into debt. They either have to cut the dividend, they have to go into the bond market to distribute bonds, so that way you can get the capital now to pay off the dividends. And companies do that. A lot of companies, when they have down years, they might go into bonds to be able to purchase back stock or to pay the dividend. And some companies do it just because the yield rates are so attractive right now. But that I'm not too familiar with. So I think a lot of people, what they do is they look at the dividends to earnings, and this is normal payout ratio. And if that's over, 80%, people freak out. But this earnings can be manipulated to go downwards because of depreciation and taxes and what have you. So I think this payout ratio from free cash flow is something that's more important. Anyway, hopefully that was helpful. And I popped out the chat, so let's go back to that. Where is that bad boy? There it is. So I just went on to the large tangent, so I apologize for that. Am I willing to invest in international markets? So To put it slowly, do American political economics play a role in my analysis? So, yes and no. Well, I guess no. No, because I personally don't really look at what the politics are going to do, per se. I'm mostly focusing on dividends, and so if that manipulates the price and the yield isn't necessarily good at that moment, I won't purchase it. So it will impact my analysis in that respect because it influences the market. But will I say not buy a stock because it's, say, Chinese, or if a company does a lot of business with China, will I not buy the stock because of the things that are going on with the trade war at the moment? This might be very short-sighted upon my part, but I don't really have too many stocks like that. I used to own Skywork Solutions, which was very dependent on that, but not so much anymore. So I think I'm going to say no, not because I intentionally do it, but because I just happen to think that most of my stocks are not very heavily impacted. Although the one thing that I am keeping in mind is I do have a position in First Solar. I think it's about 100 or so shares in First Solar FSLR, and that might be artificially inflated in price due to the fact that now there are tariffs or a war going on with China, and that might impact the United States' ability to import Chinese solar into the U.S., and so that might allow First Solar to get more of a leg up. But that doesn't pay a dividend per se, and I bought it at a cost basis of about half of what it is at the moment. So I did find out if M1 really charged me a fee. I think that they used to, and recently, I think within the last 2 or 3 months, they stopped charging a fee. So, yeah, you were correct. I tried finding it, and it used to be on there, the same portion of the site that you told me where it charges fees and whatever. It used to be right there. Somebody had a screenshot of it, and then it disappeared. So, or they took it down because obviously they stopped charging. So, did I miss anybody's questions? Pop out the chat. Yes. What about company's market cap to measure a company growth or value? Yes and no. So generally speaking, what I'll do is I put a lot of my money into decent dividend-paying stocks, companies that pay, anywhere between 2 to 5%. But I'm not, limiting it to 2 to 5% dividend yield. But earnings growth is somewhat important to me. I say that though, and I invest in companies like Verizon and AT&T, which grow it at a little bit slower of a rate. But I think on average, the companies end up paying me and growing the dividend by about 8%. And I think I did an analysis on my 2019 dividend raises thus far, and some of them were 25%, some of them were 2%, some of them were what have you. Let's see if I still have it. I think I do. So just looking at that, in total, the increase was about 8%. Yeah, and this isn't even including the recent Altria Group or anything like that. This is it does. So I have MO in here, WP Carey, and this doesn't include like me purchasing stocks like Altria Group today, because now I have more than 160 shares. Oh wait, I'll have to double check this part of it, so I might skew it a little bit, but if anything, it would drag this number down. But when I did the video, or at least I talked about it last time, it was 8%. But yeah, you can see like Kinder Morgan increased by 25%, Phillips 66 increased by 13%, AbbVie increased by 11%, Waste Management by 10%, Icon Enterprises, and so it is all dependent. Some companies raise it, 19%, 25%, but the positions might be smaller. Yeah, so you see this Wells Fargo increase by 19%, increase the income I get by $69 a year. Whereas I get Clorox, which increases by 10%, which only ends up being $2 a year. Yeah, so it's all over the place, and it all dependent on the total position size as well. But I don't necessarily focus on market cap, I guess. I think it's just if I believe the company is reputable, if they're attractively priced. And so I think it is skewed a lot of times to the larger dividend companies, larger market cap companies, because I know about them sooner. There's a lot more knowledge and stuff about them, a lot more articles written. They're more in the paper. So unfortunately, there's probably really good dividend stocks like Chubb, insurance company, that I wish I had bought because it has been increasing the dividend, and it's kind of a sleeper stock that went from small cap, and I think it's now mid cap stock, and it might have actually gotten bought out, but I don't remember. But those sort of stocks, everybody wants to know about those, but they unfortunately don't find out about them until they've grown substantially at some point. So that might not be any answer to your question, but it is what it is. Yeah, dude, $900 a month, pretty close. $890 at the moment. Well, I don't know what to believe. I have to go through the spreadsheet and see if it's 10,600 or if it's 10,700. I think in another thing it was like 10,700. So either way, very close to $900 a month. I'll get there soon enough. So it is what it is. Message retracted, huh? It's been my favorite investment. It's my favorite investment thus far. I don't know. They're all different for different reasons. So I can tell you the best investment I've had. The highest return, I think, was Petrobras back in 2015. Only had like $1,000 or maybe it's $2,000 or what have you, but it went up to like $12 or $9 or something, and I sold it. And so I remember that was really big at the time because back in 2015, I wasn't really at that moment, getting all too hopped up on dividends. Dividends were a thing for me, and let me see if I can find the new graphic that I made. Dividends were a big thing and everything for me, but I was still getting accustomed to. Man, where is this thing? Still getting accustomed to. Is it here? There it is. So I was still getting accustomed in 2015 to, growing and getting involved. Yes, these greens are my actuals. Excuse me. And so at that point, I really didn't have much in dividend stocks to really go off of, and so I was really just chasing percentage growth. And so at that point, over 100% return, I was like freaking out. I thought it was awesome. And yeah, anyway, and so now I'm looking for bigger positions, more long-term cash flow, because that's more sustainable in my opinion. And I go back and forth with this internally in my head a lot, because I think a lot of people ask this question and they say, well, if you invested, say, $100,000 or $10,000 in Apple, or one of these really great investments, Altria Group back in the 50s, or Google in the 2000s, or then once you sell that position, then you can put it in a very steady income paying stock like AT&T or what have you, and you'd be better off. But I think that a lot of times those stocks are not a 1 in 1,000 per se, but they're 1 in 100. And so I'd rather choose a decent amount of stocks, or even just buy an index fund that is going to average me over the long term, a decent growth. Everybody was like, yeah, if you just invested in Apple, but it's like not everyone knew that Apple was going to be, $1 trillion company one day. It started in a garage and grew. So, I mean, it's really easy to be like, in retrospect, you should be a growth investor. But most of the time, I would say growth stocks. Take Tesla, for example. That was a good investment as well back in 2012, 2013. But now it's not doing anything. So I think some people buy in too late. And so, not saying that it's a bad thing, but I'm sure some people have Tesla stock with a cost basis of $320 to $350 a share, and now they're not really getting anything for it. Whereas, if I have an investment like Johnson & Johnson or GE or something like that, GE is probably a bad example, but Johnson & Johnson, and the price goes sideways, I'm at least getting that income where I can take it that 2 to 3% every year and allocate it towards something else, buy more stock or what have you. So generally speaking, those companies are very focused on making sure that they're financially stable. Some companies that are focused on growth, like WeWork, I'm not calling them out saying they're bad companies, but companies like Uber, WeWork, Apple for some time, they went into massive piles of debt and almost bankrupted themselves. And even still, WeWork and Uber are losing billions of dollars a quarter and don't make money. So not to say that those companies are bad investments, because I personally don't know and I've not done my due diligence, but companies that pay a dividend are more likely to be diligent about company financial stability. And so in that respect, anyway, I went on a tangent, so I apologize, but that's just my thoughts there. Whoops. Hit 900 in August. Oh, total dividend payment for the whole month. That's awesome. That's better than I did, I think. I think I got like 700 or something in August. So 900 a month for August. That's awesome. You're a U.S. expat studying abroad, or I'm a U.S. expat studying abroad? I'm not studying abroad. If you're talking about me, to correct you, I'm working on assignment for work. Not trying to be rude, just to correct if you're talking about me. Any other questions? You guys are relatively quiet, but I'd love to keep chatting and showing this. But I don't know if you guys have seen this one yet. I don't think I've made an official video. I might have done a quick screenshot of it, but what this is talking about my initial journey from about 2012 until about my medium high goal, which is about 100,000. Current financial independence goal is around 50,000. So what I did is I looked through some videos rather sporadically, albeit a little sporadically, and put basically the annual income that I was getting from the portfolio at that time, so the forward 12-month income. So if I were to say at this point in time the portfolio is $100,000, I'll make $4,000 this year, or $200,000, I'll make $8,000 this year. So basically, just when I made that video or when I made that note, this was the income. So you can see around now we're at around 9,800 or so. I can increase this now. In fact, we can do it ourselves. And so basically what it's doing is it's adding to the lines here in the actual section. And these are some other goals that I've kind of said. This is like 30% per year growth off of some calculations that I made a little bit earlier this year, so probably about 4 or 5 months ago, trying to get to this financial independence goal in about 6-7 years. So what ends up happening is you get this polynomial, this black line. And you can see at the moment the goals are slightly underestimating, but once you get a little bit further out, because the 30% per year kind of kicks in, it kind of comes back on target. So as I continue to invest, this polynomial will, I guess, continue to feed, and hopefully that'll allow me to get my actuals in order. So that will be that. But let's just make sure that all these values are in here. Okay, so they are in here. So at the moment, we're at like, what is this, 9/6/2019. We'll kind of show you how this works. And so let's just say 10,700 at the moment. So with that, 10,700, you can see that the value kind of changed a little bit, kind of went up because it's a little bit faster than what it's used to. And so it is what it is here. So going to keep updating this because I think this is a really cool goal and it kind of visualizes everything. I've showed this bar chart before. Let me pull that up. I've showed this bar chart before, and I think it's useful as well, but I think that maybe showing the actuals. I was trying to get the actuals on top of this as well, but it did not work out. So anyway, hopefully this is kind of a cool little thing. So 50,000 is the current goal, 6-7 years hopefully, and then the next goal after that, a couple years thereafter, would be 100,000, and so that's looking like in about 11 years or so, it'll be 100,000 a year. So we'll see. Still relatively early. Yeah, I mean, I basically went from early 2016 making zero income from dividends. Oh, it was around $10 to $20 a month, and then now, 3.5-4 years later, 10,000 a month. So it can add up relatively quick, and hopefully that's a little inspirational for you guys. Were you at Christian? What does that mean? Gen X, I'm trying to understand what you mean by were you a Christian. Oh my God, my sister's on here. Hi, sister. Thoughts on BP stock? I don't necessarily know about BP stock at the moment. I have a decent amount of BP stock, and I believe it pays a good dividend. But to be fair, I've been focusing a lot on Shell at the moment. But I think both BP and Shell are really trying to advance themselves in the future with respect to investing in more long-term energy strategies, like renewable energies, like BP specifically is doing a lot of things in Brazil, trying to do sugarcane and what have you. And then Shell is doing a lot with LNG and really trying to make the transition from oil to more of a less carbon-intensive fossil fuel like natural gas and LNG. And so I think at the time in 2015 when Shell bought BG I believe people thought it was overvalued, but I think in retrospect it was very well received. So for me at least. Do I have a minimum threshold for investing in a new company capital-wise? No. I think just whatever I feel at the moment. So some companies I'll dive all in and put 5,000-6,000. Other companies I'll put 2,000 to 3,000. I think it's just all about how I feel at the moment and if I have the pockets at the moment. Because sometimes throughout the year I kind of just put my head down and do my work on my 9 to 5, and a couple months go by and some money piles up, and so I'll have upwards of 5 figures worth to invest. Luckily for me, but other months, I'm really diligent about checking the checking account at the end of the month and seeing if it's something that I can invest. Just checking that I'm showing the desktop and not my face. So that way I'm not making any weird faces. How do you build your dividend income so fast? Just continue to invest, man. So I know if there is a pending market crash, it'll go down, 10, 20%, and that's fine with me. But I'm just continuing to invest in companies that sell good products to people. So companies like Clorox or Colgate, for instance. I don't invest in Colgate per se, but you're still going to brush your teeth, yeah. So and companies like BHP, that's a really good one that I like to think about, because when I was investing in BHP, and I'll pull that one up because I think it's one of my better investments that I've made. So when I invested in BHP, I bought about 100 or so shares. I actually ended up with about 200 or so shares at one point, but I sold some of them, and I wish I hadn't. But the cost basis of the shares that I did hold on to were around $21, $22. And what my thought was, oil and gas company went through like a really bad downturn at the end of 2014. I forget what the price was at one point, but then it dropped down to $28 at one point. So a lot of companies were struggling because a lot of service companies were really starting to inflate their prices because people were trying to compete with each other and what have you. So BHP is also partially an oil company, but they're also a natural resources company. So they do a lot of copper mining, iron mining, nickel mining, stuff like that. So they're more of like a natural resource company rather than specifically like an oil and gas company. So at the same time, oil and gas went down, nickel and copper and iron. It was like the perfect storm for BHP. Like everything went down, and so their stock price dropped from like $60 a share down to like, I believe at one point it was like 15, $16. And so I was buying the whole time. I bought, unfortunately, at $35. I bought at $30. I bought it, and so I think the lowest I ever paid was like $18 a share. And so my cost basis ended up at one point down to $22. And I believe, I sold some of the shares at break even, but the shares that I held on to were at $21. And so, like I said, I had built a position up to around 200 shares at that point. So now I'm up to about 135 shares with reinvestment, and the yield on cost is around 17.5%. So of that initial investment, which ended up being around $2,400, I'm getting around $400 or so a year in income from that. Now, BHP is a little bit unorthodox with respect to they don't necessarily increase their pay, but they do a minimum 40% or minimum 50% dividend payout or whatever, and I'm cool with that. But the reason why I'm bringing this up is because people aren't going to stop buying nickel. People aren't going to stop buying copper. They're still going to build. Places are going to still need those natural resources. And so BHP at the time, it was like between them and Vail Corporation, and I was looking at BHP, and yeah, they had a little bit of debt on the books, but I was like, there's no way this company's going down. You know what I mean? Like, it'd be, and I was like, if it does, woe is me. I can't really say, I didn't, it was a terrible investment. Like, something crazy should have happened, and the same with like Exxon and Shell. It's like those are good investments, and people are going to continue to buy energy, in my opinion. So if that's the case, stick with the industry leaders, companies that have good income and balance sheets, and as long as the industry is doing well, you should also be doing well. So things that you're always going to need. Waste Management is one of those companies as well. I wish I had bought. I remember talking to my friend about it in like 2010 or 2011, before I even like was investing in stocks. It was like a small inkling in the back of my mind, and I was like, dude, I was talking to him. I think we were just like sitting. We were still in college at that point. I was home on like summer break, but I was like, Waste Management is like the best named company of all time, because obviously like their name is what they do, and also people are always going to have trash, and they're always going to want it to be taken away. So like, what a great business model. You know what I mean? Like, literally, Waste Management, people are always going to want somebody to take trash from their home and put it somewhere else and not have to worry about it. So people will always pay for that. It's the simple things like that, that I think are great investments, and just knowing when you think you can purchase. So I generally, whenever I see a position go down, like Johnson & Johnson or 3M, I will purchase those stocks on the low, unless I think, like with Kraft Heinz, it's different. I'm not going to chase that one because I personally think that there's something fundamentally wrong with the company in terms of culture, and the business model is old, and I think it was heavily full of debt, and so the balance sheet isn't as good as I would like it to be. So that being said, I didn't purchase Kraft Heinz, but Altria Group and Philip Morris, I think, is a good example as well. Yeah, they have a little bit of debt, but I think in the long term, they're positioning themselves well for a smokeless tobacco future, and they're being active and they're trying to innovate their products, or at least partner with companies that are innovating and creating different products. So in that respect, they're going to benefit from their investments with that. So study your bachelor in Barbados. That's awesome. Dividends monthly consistently at what dollar value? So forward income for 2020, if I were to not have any dividend cuts or anything like that, will be at around 10,600 or so for next year. And so if you divide that by 12, it'll be about 890. It'll look a little bit different. So this is the graphic that I use. So looking at this green, this green is 2020. So let me expand on this a little bit. But so this green, you can see, generally speaking, in the first 2 months of every quarter, like January, February, making a little bit under 800 a month. And then the third month of every quarter is, generally speaking, my largest. I might have to adjust this key here. Good problem to have. But so yeah, I think that's just because of the amount of capital that I have and companies that pay in the third quarter. So companies like Johnson & Johnson, 3M, Wells Fargo. I think just a lot of companies, because it's the end of their fiscal quarter, end up paying their dividend. They know what has come in that quarter. They know basically what they can pay out and if it's safe. And so I think it just ends up being that way. You can see that March and September are slightly higher, and that's because I have a couple semi-annual payers like Disney and BHP that pay me in March and September. And so therefore, those months are a little bit skewed even higher than June and December as well. But the whole goal very, very recently is to get on average around $1,000 a month. So relatively close, around $900 a month. Some of you saw about $890 a month for 2020. So 2020's goal, by the end of the year, I want to make over $12,000 in dividend income. So with how quickly I'm approaching that number, I might have to revise that in the next couple months. So whether that number goes from 12,000 to 13 or 13,500, I don't know. But I think it all depends on what growth is this year. And so let me see, do I have one here? So at the moment for 2019, I've been able to grow about 57% over last year. So last year I made about 5,600 in total dividends. This year I'm on track to make about 8,900, maybe 9,000. And so if that's the case, the growth from 5,600 to 9,000, that's like, that's 57%. And so next year, without even, having any more capital, just for the fact that I now have invested capital like the 3M that I just bought, the Johnson & Johnson, just those paying out for 4 quarters instead of the 1 quarter that I'm going to get in 2019, that's going to get me up 18% just from that. So really cool how things kind of play out. So it's just cool what you see in the numbers once you actually start playing with them. So companies are social responsible play a deciding factor in your stock price concerning companies like BP that affect the environment. Yes and no. I mean, I think this one's a little bit difficult because I invest in stocks like Altria Group and BP and Exxon, all of which do impact the environment. But I think it's easy for people in first world countries and companies or countries that are so established to concern themselves with stuff like this. But if you go to countries, that are less established or continue to grow or are just hitting their industrial revolutions, and I might be getting the terminology wrong, like Industrial Revolution or what have you, but countries like India, China, those guys are a lot less concerned about waste management and carbon intensity and things like that. So I'm not trying to downplay the fact that those companies are not doing something that's great or environmentally friendly, but at the same time, countries like China, India, the U.S. even, they need this energy to continue their day-to-day lives, and so many things rely on the products that they make. I mean, I don't think that people even realize that plastic bottles are made from things that you get out of refineries and what have you. So I think in that respect, I think it's easy because we're so along in our business cycles, and we've already been through our industrial revolutions, and we're so advanced. I'm not saying that countries like India and China aren't advanced, but I think that it's easy for us who have gone through these regulations and tried to restrict, carbon intensive investments to point the finger, but other countries still, need them. And I believe countries like the U.S., UK, more established nations in terms of businesses, they are growing their carbon intensive fuels a lot slower than countries like India, China. And so I believe, and also if you look at renewable energies, that's growing really fast as well. So it is what it is. So that's kind of a dance around your answer, and I apologize, but it is what it is. Any other questions? Otherwise, I might just keep messing around here. Let's see what else comes to mind. Yeah, what is this off by? So this is 713, and this says 682. So it's off by like $30, $35 or something. So I gotta figure that out. Any other questions, y'all? And of course, what was I gonna say? There are people that I keep trying to reach out to about specifically having like a Google Hangout with other dividend investors and what have you, but just hasn't happened yet. So I need to keep poking them. So comparing my account to the S&P 500, so that is something I think about as well, whether or not I should just invest in, say, the S&P 500 and let it go. But I think in terms of what I'm trying to do at the moment, which is income replacement and making sure that if anything were to happen, I'm financially stable. I think that the income that I get from the stocks is more important than, say, the actual growth of the total value, if that makes sense. So in my opinion, I'd rather have a portfolio that will consistently pay me $100,000 a month, or not $100,000 a month, $100,000 a year. Sorry. Then let's say like $2.5 million. Because I don't know if that $2.5 million is invested in Tesla or Apple, and I'm not saying those are bad companies to invest in. I'm just saying at that point in time, I don't necessarily know. So I'd rather have a company that has, a portfolio that has built a comfortable moat that is paying me $100,000 a year that I can pay my bills with, than a total capital value. Because I know for a fact that every 3 months I'm probably going to get $25,000 worth of income, and I can use that to pay my bills. Whereas if I have $2.5 million worth of stock and it doesn't necessarily pay a dividend, or it pays 1% or 1.5%, it makes it a little bit more difficult to have a steady stream of income to then pay bills. Or I'd have to sell a portion of the portfolio every year and do a lot more guiding of the portfolio, and it makes it a little bit less admirable. And that's just how my mind works. I'm not saying that that is the way that everyone should do it. I think that everyone has their investment criteria. So somebody's saying they don't want to look at the portfolio, they get zero enjoyment out of doing it, they just want the money to grow. SP 500, I think, is the way for you. But for me, I'd rather sacrifice 1 or 2% growth a year because it's a hobby of mine and I like doing it. I like making these videos, and I think they're more interesting to make when I'm able to say, oh, I bought 3M, look at its discount, or, and I'm not trying to be flashy about it or anything like that. It excites me, so I'm just doing it because I'm excited about it. I'm not saying that you should be, but you have to do what's right for you, and what I believe I'm doing is right for me. And of course, maybe down the road, hindsight is 2020. I'll be like, yeah, I should have just invested in the S&P 500, but I'm having fun doing what I'm doing. So, in my opinion, that's the best of both worlds. I might be losing a little bit of value, leaving some value on the table, but I'm having a lot of fun doing what I'm doing. So, Frank Invest, I have sold at a loss. GE, did I sell a break even on GE? I remember my cost basis on GE was pretty good. It wasn't like $8 or anything like that, but I'm trying to think. I didn't sell at a loss there, but I've sold at a loss before. I've sold at 50% losses, and generally speaking, they're very small positions, very small positions. And so there's been some times where I'm like, man, I've had like a position that was like worth $1,500 when I first bought it, and it lost 500. I was like, man, this is a good buy. I'll take like this Johnson & Johnson recent dip, for example. I was like, that looks like a good buy. And I'm like, I only have 3,000. And then I'll just have this big red eyesore looking at my Fidelity account or something like that. And I'm like, I don't believe in that stock. It was a mistake, in my opinion. I don't necessarily, I was in a different mindset when I purchased that. I'm going to get rid of it. And so I'll say take the $500 loss, take that $1,000, add it to the other $3,000 that I want to invest in a Johnson & Johnson, and now I have 33% more value, or 33% more shares, rather, in Johnson & Johnson than, having, say, 3,000, I now have 4,000, and I've gotten rid of a stock that I don't necessarily care about in the process. So hopefully that answers your question. I don't think I've sold at a loss just because I'm at a loss. I've sold because I want to use that capital for other reasons, not because I've gotten emotional. I'm sitting on a lot of losses at the moment. I mean, not a lot, but Chesapeake Energy is down. My Kinder Morgan is down from when I purchased it at. My Sidua Partners is down from what I purchased it at, and so I don't look at them as badges of honor or anything like that. But you win some, you lose some, and there's some 100% wins that I've gotten in like BHP, First Solar, Petrobras, and so those I think far outweigh the negatives of the small positions. Like Chesapeake was like $900 or $1,200 total, and now it's down to like 100 or so bucks. So I mean, it was $800, $900, and I've now have simple investments that I made in like Pepsi, less than 2 years ago that went from 95 a share up to 130, 140. And now I own, a decent amount more shares. My yield on cost is a little bit better. Let's check that one out. I don't know what my yield on cost is on Pepsi, but it's probably pretty decent. So yeah, Pepsi, my yield on cost on Pepsi is about 4%. Not that matters per se, but I thought I had more shares than just 54, 53, or 50, whatever. But $205 a year, can't complain with that. Yeah, I mean, purchased it at 98 was the cost basis, and I don't know, it's probably like 130, 140 at the moment. I haven't updated the values in this tab in a little bit, but good for 40%. So Main Street Capital is another one that I continue to buy, and bought a bunch at 32 on average, and now it's up 40%. This portion pays me, $400 a year. So Another company that I keep holding on to that hasn't really gone anywhere is my Wells Fargo, but I'm very optimistic that Wells Fargo will continue to be around for quite some time, and if it isn't, it'll merge with a different company, and whatever company it merges with will probably be an industry leader. And so in the long term, this $10,000 investment will be worth something, a decent bit. And at the moment, I'm getting $112 every quarter to hold it. So it's my thought process. What else I got? Not fun and losing time, yeah. Jeez, but not good. Uh, 25 positions and 3K invested. There's nothing wrong with that. So I think that might be the only reason why I think that might be a mistake, and this is from my personal opinion, so I'm not saying it's a mistake, but I don't know if you have those, specifically talking to Frank's Invest. I don't know if you have that in Robinhood or if you have that in like M1 Finance or what have you, but if you're investing in something that doesn't necessarily pay any fees for transactions, I don't think it's a bad thing to have 3,025 positions, because if say you only have 3,000 and like one or two positions, not saying this is 100% true for everybody, but I think for me, I think that the first couple of years when I was really investing a little bit here, a little bit there, is how I learned to continue to develop my strategy. I didn't have anyone sit and tell me like, hey, you gotta think about what's right for you. And I had people, not trying to belittle anybody, but everybody that I know of, always on YouTube at least, or on the internet, or through television advertisements or what have you, they always like, oh, you should invest in penny stocks or invest in real estate, or and I'm not saying those are incorrect, but they're not for everybody. Penny stocks might be for someone that needs 100% return next week because they want to buy a nicer home, or they don't care about the money that they got, or what have you, but or they want to be very active in their investing and they can see trends very well, or what have you. So I learned a lot from having multiple positions, smaller positions as well. I remember $200 positions used to be a lot for me, not too long ago. Like I said, 3.5, 4 years ago, I wasn't making more than $20-$30 a month in dividend income. So I'm not too far off from where some of these guys that are following me on this channel are today. I had somebody say they're making $10 a month and paying their Netflix bill just from their $10 a month dividend, and that's the way you got to look at it. I look at it like, I have fun little games with myself. I'm like, oh, I have how many shares in Verizon? Oh, I can almost pay off like 4 months worth of my phone bill, or like let's say like Wells Fargo. It's just like, well, it's like if I ever decided I needed a loan from them, I have this that I can bargain against the loan, or what have you. Not saying that that's the truth, but small things like that, small wins like that, where you're kind of saying, oh, I get $400 a year in Clorox. That means I can buy any Glad Tupperware containers that I want, because I'm not going to spend $400 in Tupperware a year, or trash bags, or Burt's Bees chapstick, because all those are brands of Clorox company. So you look at it like that, and that's all you're really doing, right? Is you're trying to offset those expenses that you come home with at the end of the month with dividend income. So that's the way you got to look at it, and those are the fun wins, and that's what keeps it exciting, and that's what keeps you interested, and that's what keeps you investing. So I don't really know what you mean by risk ratio, so that might make me look like an idiot, which is fine, because I'm just doing what I think is right for me. But I was like seeing this 192%, and I was like, what is that? 50%. That's good. So risk ratio, yeah, not 100% sure what you mean by that, but I do it with a sort of feel-good ratio. I mean, whether you call that a risk ratio or not. I mean, am I acknowledging that like Altria Group per se might be a bad investment? Yeah. I mean, I'm not. So this is another thing is I'm not investing money I can't lose, or I shouldn't lose. I guess I could say. I mean, yeah, this money could be used for retirement, but I mean, if I were to lose, say, $3,000 in this stock, am I going to lose my household? And the answer is no. And so, I generally look at it that way. I mean, I personally believe that the American economy and the international economy, which a lot of my portfolio is invested partially into international investments as well. If you look at international oil companies, BHP, First Solar sells things worldwide. What other companies do I have investments in? Kinder Morgan has things across Canada. What have you. I mean, yes, the share price might go down, but in my opinion, not all business is going to stop unless there's something drastically wrong, like a World War III, where and then the whole entire planet becomes a nuclear wasteland. Because in my opinion, if you've had 6,000 years of recorded history that we know of, where people have been utilizing currencies to purchase things from one economy to the next, and people will continue to purchase goods with each other for the last 6,000 years that we have recorded history. I'm anticipating that investing in businesses will continue to be something that wealthy folks do for passive income and what have you. So don't necessarily know if that answers your question, but the only thing I worry about, I think personally, is if investing in, say, the U.S. economy or international economy, what would I do in a scenario where all economies failed? And I don't think that I could really plan for that scenario. It's like, yeah, maybe I could buy gold, but I mean, I think even then, things I think will probably be better purchased with oil, gasoline, what have you. So you start getting down a very dark conversation like that. Sure, I can understand that. So I started when I was in college, so I guess to give you insight on where I started, and I'm not trying to make you feel better or worse, I'm just talking you through the situation. So, I went away in summer of 2012 to do an internship, and with that, I was making, almost a full-time salary. Not, how do I say this? My salary that I was getting monthly was like as if a full-time salary. So like as if I was making, an average American's monthly salary. Yeah. Not saying I was making like $50,000 every month. That's not what I'm saying. I'm saying I was making, $4,000 to $5,000 every month. So doing relatively well. And so over the summer, I was able to build a little bit of a nest egg. Obviously, having very little commitments, very little rent, payments due, because I was fortunately paid for by the organization I was working for. All I really had was like food and gas expenses, maybe some insurance as well. But luckily, I was still kind of under the roof of my parents. So that being said, I spent a little bit of money, obviously, to have fun that summer, but I ended up walking away with saving over 50% of what I made that summer. So, I'm not saying that you need to work harder, because that's not always the answer, but maybe you just need to work a little bit smarter. And I acknowledge that now the university has restarted, so it might be a little bit more difficult to get a job, but just continue to hustle and figure out what you can do. There's always little things on the internet that you can do, and I feel like I'm left behind because like I either think I need to be doing things more on sort of like a internet sort of economy, but I never end up doing it, or a lot of people that I follow on Instagram that do these like membership groups, and not saying that's the right way either, but I think those are really cool, and they at least get income, and I think a lot of people that are in the membership groups get a lot of value out of it as well, in growing their income. So it is what it is. But I think if it's something that is truly emotionally impairing you, it might be worthwhile to stop thinking about conventional methods of making money, like a 9 to 5, because that might take more time, and just do something like, I don't know, I'm not saying drop shipping is the answer either, but you can make money doing anything now. So, yeah, no, I appreciate it. That's means a lot. I do it to document my journey, and also hopefully inspire others like yourself to really try to understand and change their mindset on things. Because I think a lot of people, they hear like, oh, somebody gave me like $2 million today, I still couldn't retire. And I'm like, how could you not retire? Like, if you invest that at 4%, like that's $80,000 a year, and blah, 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 blah. And it's like, I hear people that immediately close their mind. And I forget what, it wasn't a motivational speaker, but it was like, I think it was Robert Kiyosaki. He said, a statement closes the mind, a question opens the mind. And so specifically in this context, it's like, well, not trying to belittle your situation, but it's just like, oh, I only have $5,000. How could I invest? Like, that's not a lot of money. That's not going to get me anywhere. But if you flip it around and change your mindset about it, it's like, well, I have $5,000. I'm in the university. If I invest this $5,000 into, say, the S&P 500, or into dividend stocks, or say real estate, or drop shipping, and I'm able to turn it and grow it at say 5-10% per year, I'm going to be way ahead of my peers because I'm still in the university. I mean, you have to think that I guarantee over a third of Americans don't have any sort of investments or stocks. So the fact that you're still in university, you're relatively young, I anticipate, and you were to invest, you'd be ahead of the game. But I think only your initial investment is just the start of the journey. Yeah, I mean, so maybe this will be helpful as well to you and others on the stream here. But had I just been like, okay, yeah, let me invest for a year, and keep in mind, I'm investing a decent amount of capital every year, so this isn't small change. But keep in mind, it's all based off a percentage of your portfolio. So if you're saving, 10% of your income a year, you're going to be working for 40 years. I mean, it's all dependent on how much you're saving over your income and how much you're expecting to be making as a percentage of your income. And it's a different story for a different day. But just taking this year, for example, so from 2016 to say, well, I'll even take to 2018. Hell. So I'll say 1/1/2016 to 1/1/2018. So these 2 years. And I can expand this to say 10,000. So we get a good view. So I would have gone from $168 a year in dividend income, so just over $10 a month. What is that, $14 a month, whatever? So maybe close to like $5,000 a year. And I remember telling my mom, I think it was, I'm not trying to, talk down upon this either. It's just showing you how you can change your mindset on some of these things. I think I had just crossed $5,000 or $6,000 a year in dividend income, so it was like 2 years ago maybe. Probably sometime in 2018. And I said, yeah, well, I was like, even not working or anything, I'm still going to make $5,000 or $6,000 next year. And immediately I got, that's not enough to live on. How could you live off that? And this is that. I'm like, that's a closed mind. Like, that isn't thinking about future possibilities of what that would bring. Let alone, I was like, 25, 26 at the time. $5,000 or $6,000. If I was living in, other parts of the world, Southeast Asia, or, that could be half of my expenses paid. I mean, some of these countries, if you move there and you're making $10,000 to $20,000 a year, I mean, you're living a pretty great lifestyle. So I think it's just a start. And what I'm trying to say is if you just do one investment, you might go from zero to, I mean, we could just do the math really quickly, but $5,000 a year, or $5,000, if you invest that 4%, you're going to be making, what is that, $200 a year, yeah? So you might like invest that $5,000 and like, oh, I'm only going to make, $16 a month or $17 a month. And that might not be a lot, but it's the next 5,000 and the next 5,000 and the next 5,000. And next thing you know, you're going to be making $100 a month. And you're like, wow, I don't have to pay for a cell phone bill anymore. Like, that's really impressive. And you do another 5,000, another 5,000, another 5,000. And if you think about it, if you're doing 4%, every $20,000, $25,000 that you're investing is $1,000 every single year that you can take off of your life. So, I mean, you could say, well, I'll do that with dividend investing, or you could say, I'll take that $20,000 and put it in real estate. I can make more money. Whatever suits you. But I think the biggest part is, and hopefully it's not trying to like convince you to do dividend investing. I think it's more along the lines of just changing your mentality about what you can do, and maybe just getting enough to your financial independence goal is enough. Maybe you just want to say, I'm going to get to the point where I'm making $10,000 a year. I'm 35, and I'll let it compound. And if it compounds, it compounds. And if it doesn't, then it is what it is. And I'm just going to live off that. In 10 years, I'm going to retire. That's cool too. I'm not saying you have to, continue to working forever. So, anyway, retire in Jamaica. Yeah, it's pretty cheap. I'm in trouble now. So hopefully that helped, Christian. Jamaica is definitely a place I want to go to. It's got a lot of culture, and I've met some folks here in Trinidad that really talk a lot and heavily about it, and they really enjoy it. And I met some other folks in Mexico when I was there a few months ago, and they absolutely love Jamaica. They showed me beautiful pictures, and so yeah, it's definitely somewhere that I want to go. Brief overview on my taxes, how I account for them. John, I don't really have any prepared material for that, but I think one of the things that I've recently discussed in a video, in fact, I can see if I can pull it up rather swiftly, I'll say, is just acknowledging what you're investing in. Because I think, especially for me, what I always generally look at is I don't want to say get hit with a sucker yield, but I think what I always kind of get hit with is I always generally will look at the yield instead of kind of thinking about how the taxes might impact it. And so companies like Realty Income Corporation, so before I continue to go on, so the link that I just put in the description is talking about ordinary versus, or qualified versus non-qualified dividends and what companies, and I got yelled at because it was before Trump tax cuts and what have you. So the actual cutoffs of income brackets for the non-qualified dividend part of the video might be off slightly, but the concept is still the same. So if you just adjust it for whatever tax bracket you're in the gold. But basically what it's talking about is 5% dividend yield investing in Realty Income Corporation. if you're making, say, $400,000 a year versus a 5% yield in a company like BP, in a non-tax advantaged account, so not a Roth IRA, but like an individual brokerage account, a normal taxable account, it may be worthwhile if you believe the stability of a company like Shell or BP that's paying 5% at the moment might be a better investment if you're like a retiree or what have you. So it all is all subjective, yeah. But reason being is because companies like REITs, business development companies, master limited partnerships, they pay taxes through the dividends or the payouts that they're giving to the shareholders or the partners in some cases. And so that being said, while you might see a 5% yield, that's on the non-tax portion of that. And so the company might be able to pay out 90% of the profits or earnings in dividends, but then those 90% earnings are then taxed through you. So you might have to pay what is called a non-qualified dividend. And so therefore, if you're making $400,000 a year and you make $10,000 in dividends from, say, Realty Income Corporation or another real estate investment trust, you're going to get that $10,000 taxed at 35 to 39%, depending on what the tax bracket is. Whereas if you were to, say, invest in a company and make $10,000 a year in dividends from, say, like Exxon or Waste Management, Clorox, Johnson & Johnson, 3M, those are qualified dividends. And so unless there's some sort of merger and acquisition or anything like that, if it's just a normal qualified dividend, you'll only have to pay 15 to 20% of capital gains. So you might actually be able to keep 15 to 20% more of the money in dividends because of that. So hopefully that's helpful. But yes, I've acknowledged that within my portfolio, and I've noticed that I do have quite a few real estate investment trusts in my normal taxable accounts. And so while I generally only calculate my gross dividend income, not including taxes, what I should maybe do is do a brief video on what that actually means after taxes. And so that might reveal a little bit too much because it might, discuss what my personal income is as a whole, not just my dividend income. But maybe that's not too big of a deal. I'll calculate it for myself and see what it is. But I do try to put business development companies, REITs, inside of a tax sheltered account like a Roth IRA. So that's why I have. Let's see what's in the Roth at the moment. So in the Roth, we have like BHP, Cyrus One, which is a real estate investment trust, Icon Enterprise, which is an MLP, Main Street Capital. I don't know if this qualifies as something that actually is non-qualified dividends, but I think they pay out capital distributions instead of dividend distributions. So I think in that respect. And then I also have WP Carey, which is another real estate investment trust. So a decent amount of income in this part of the portfolio coming from non-qualified dividends. So this company, Icon Enterprises, yep. So over $1,000. So that could be a tax savings of, say, $200 there if I was being taxed at, say, 40%. Probably not, but maybe closer to, say, 30% or so. And my capital gains rate will be about 15%. So just from that, I get to keep an extra $150, let's say, if I were to, say, invest that in a regular taxable account. So any books to read? I'll tell you a really good, and maybe you'll be like, really? But a really good thing that one of my friends, we chat back and forth. She's a really good coworker of mine, and we kind of do like personal coaching. So like we talk about where I'm at in my career, where she's at in her career, and we really just like go back and forth, and we um, we'll talk about it in that respect rather than being like, oh, you should do this or oh, you should do that. We kind of like mentor each other. So this is a really good video, and to give you background on it, Jim Rohn is a motivational speaker and very well off. I don't know if he's still alive, but the video that I forwarded you guys to watch is around 2 hours, so not saying you should watch it because there's not a lot of content visually for you, but if you're, say, doing medial tasks around the house, or you're walking the dog, or you're working out, or you'd be listening to a podcast, throw that on, and I'll be 100% upfront with you. It was made in 1981. So in that respect, some of the jokes are a little bit dated, but a lot of the content is still the same. And you'll hear what I said a little bit earlier, like, oh, something from 4,000 to 6,000 years ago for recorded history that we know of. Part of that was from this. It's, slightly derived, but this is really good about if you want to set goals, if you want to stop, I guess, focusing on the wrong parts of your life, if you want to be a better brother, parent, anything. I think that this is a really good thing for you. It's about 2 hours long. There's other videos that stem off of this, other versions of it. But yeah, so hopefully that is good for you guys, and hopefully you enjoy that. I like it a lot. There's other folks that I listen to, and I watch their videos. I watch Grant Cardone because he's funny, and I believe in what he's doing. I think he's taking a little bit too much vacation lately, but he's deserved it. He's in his 60s now, so he's worked hard and he's built a really good business. But there's other people, that I listen to. I listen to anybody, wherever. So this is one thing that I was given. So take this with a grain of salt because it's maybe not 100% true, but listen to everybody and then make your own opinion out of it. And that might be useful, but maybe not everyone is worth listening to. And so if you do that, you might be wasting some of your time. But if you listen to everybody or listen to select few people, or you listen to, say, CEOs or motivational speakers, don't necessarily do everything that they're telling you to do, but more formulate and see how it works for you. So Bogglehead's Guide to Investing, that's good too. I think I've read that. I don't keep up with it per se, but it is pretty good. Getting back to MG and their question, yes, I try to max out my Roth IRA, every year, because it is allowing me to invest, say, $5,000-$6,000. Well, I guess in this case, is it $6,500 or $6,000? I don't remember. $6,000 tax free, and so if you put that at a 4 to 5%, that's anywhere between $250 to $300 a year in dividend income that I no longer have to pay for. And if that, say, grows to, say, $10,000, $20,000, I can sell that or redeploy that capital elsewhere without having to pay any capital gains on that. So highly beneficial, highly useful. I generally take advantage of it. Let's see what other questions we got. Yeah, so there's probably a lot of European investors that I would like to listen to or get to know as well. Fortunately for me, now that I sell the spreadsheet that I kind of show you guys here on the screen, I can kind of see where folks are buying it from. A lot of people from Canada, a lot of people from Europe. Not a lot of people, but a large percentage of the people that have bought, are European. A lot of people from Texas, a lot of people from Pennsylvania. So it's kind of fun to see. You get to know some of the people that watch your videos, know where they're from, kind of chat with them in the comment section. and then you kind of see them actually purchase from you, and they're like, yeah, they're telling the truth. They're from Texas, so it's kind of funny. But excuse me, had to wet the whistle there. But haven't eaten dinner yet. We got to think about that. Maybe got some sandwich materials in the fridge. But if there's any other questions, let me know. I might try to wind this down. It's been quite some time. Let's see how long we've been on here. Doesn't say there. Oh, an hour and 39 minutes. So we've been on an hour and 39 minutes. If there's any last few questions, more than happy to let it go. Hey, man. Doing good. Took my advice, got hired as a bus driver for a different company. So now you invest a second and third check. All right, man. You mean you quit your first job and you moved to a second job because it made you happier, or you got a second job? Yeah, man, that's really awesome. As long as you're happy and you're actually able to start investing for your future, that's awesome. I think I remember having a conversation with you, and you were frustrated, understandably, that you weren't where you wanted to be, and you wanted to invest, but you felt like you were somewhat trapped. I think that was you, and we were having a discussion in the comment section. So if that's you, it's really awesome to hear that you've really helped yourself out there. That's awesome. And you did it on your own. So keep in mind. So you didn't have anybody else. You personally did that, and that's something that you should personally look down into yourself and recognize that you personally did that. You were upset. You made a change, and now you're reaping the benefits. So, congratulate yourself and make sure to always think about the small wins, because sometimes if we go too long without, rewarding ourselves, we get frustrated and we revert back to our old mentality. So, dude, mentioning you. Oh, yeah, absolutely. I thought you said mentoring. I was like, oh man, we talked in a comment section once. I would call me mentor, but yeah, okay, I misread that. Mentioning you, absolutely, man. Anything. But if I'll give you the spreadsheet for free if you message me on Instagram at Novus here, or I don't know if my Shopify account lets you ask questions or contact me or something. If yes, I'll put the Shopify link. If it does let you, excuse me. If it does let you contact me or something, just do that. I'll send it to you for free. Not a problem. I'm really proud of you. Your story's making me tear up, and I'm really that sort of stuff gets me motivated. It keeps me going. So reach out to me on either of those platforms, and I'll send you a copy for free of charge. Otherwise, it's like $1. So I know it's not too expensive, but anything that I can do to help you out means a lot to me. I do it more, not necessarily to make money. If I was doing it to make money, I'd be charging $5-6. I'm doing it more to control the cost. I have to pay like $25 or $30 a month or something to keep my Shopify store positive. So I'm basically just like doing it to keep that cash flow positive. I'm not actually like losing money. But set up $529 for your 3-year-old. Fees are steep. Ooh. So that's a good question. So if you, thanks, man, Kia. I'm with you. Almost hit 900. I'm at like 890 a month, which is close. So like I did like the math. It was like another $200 invested, and I'd be able to hit that because all I need is like $8 or $9 or $10 a month. Did I do that I think I did that calculation wrong. I 100% did that calculation wrong. I need to multiply that by 12. So I need to invest like another $2,000, not $200. Anyway, sorry. So back to MG. For a 529 account, this is something I also think about because I have some nieces and nephews, and I do 529 accounts for them, which reminds me I need to set up the 529 accounts for my nieces. But for my two nephews, they're a little bit older now. Older meaning I've had their accounts for 5-6 years now. I haven't checked the fees associated with it. So I need to. I've also thought in the past about just investing in, say, a taxable brokerage account. But who knows? Because at the moment, investing in a 529 account, I don't have to pay any taxes. But if I invest in, say, like an individual brokerage account, I have to pay taxes. But at least what I noticed, the fees that I saw were under 1% for the 529 account. And so the fact that it was tax advantaged, it was under 1%, and it saved the hassle of me having to monitor that. While I like to monitor income and dividends and what have you, monitoring like a 529 account, that would take a little bit of fun out of it. So I kind of just passively do that. But if you find out anything, please let me know, because I forget what two states I invest in. They're both different states. One, I believe, is New Hampshire. I forget what the other one is. So, but Christian Price, hopefully I find you well. Hopefully, second drive. Okay, cool. Gotta love positive communities. I agree with you, man. I'm curious, Christian, are you 3% per contribution? Yeah, dude, you got to figure that out. That's too much. So back to Christian. What are you going to school for, if you don't mind me asking? It's awesome. I'm inspired. I hope that what do you plan on doing after school? This is probably getting too deep, but for some reason, you've been asked a lot of questions, and I feel like I need to know, like what are you doing? What are you learning? What are you trying to learn? What are you going to do with your life? Are you going to be an engineer? Are you going to be a doctor? Probably going to be a doctor, and save lives and stuff. So I'm inspired. You seem like you got your head on your shoulders. So don't even know how many people we got on the Chisity chat. 8 people. We lost some folks about an hour in, understandably. But we got up to 18 people at one point. 20 people at one point. So yeah, trying to think if there's anything else. If you have any other questions, I'll give it a little bit of a moment. That's awesome, man. That means a lot. I don't know if you're just saying that to be nice, but financial career is something that I've debated as well in the past, where I've been like, oh, if I wasn't doing engineering like I'm doing now, is financial education or being like a financial advisor or a certified financial planner more what I would want to be. And I have thought about also like going to school and passing my own personal like Series 63 or Series 7 or whatever it is, so that I would be able to open up like a certified financial planner's office. Because I think a lot of my friends at least, they always ask me because they know I don't think they ask me because they know I'm good at it. I think they ask me because they know it's always a topic of excitement for me. Financial investing and business, and so they always ask me like, oh, like what should I do with this or what should I do with that? Maybe because they want to see, and some people, unfortunately, against my advice, have invested in things that I've said, and fortunately they've always made money. I haven't always made money, and sometimes they joke and they say, well, every time you say you're investing in something, I'll wait 6 months and then I'll invest in it. And I think I made that case with like BHP. I was investing in like I said, all the way down. And so at that point, my cost basis, like I showed you, is like 22, 23. I have a coworker that was like, hey, yeah, it's like really cheap right now. I'm gonna buy it. And I think he bought it at like 15 or 16 bucks. So, and he bought like 10 grand worth of it. So he's probably got like a $20,000 position now, higher yield on cost than me, all that jazz. So kind of funny. But anyway, um, that's really good, man. Yeah, seeing your learning from life and changing outcomes because of what you observe and your perspectives. That's really admirable, and I wish you all the best. That's really awesome. Kristen, do you have my spreadsheet as well? If you don't, message me on any of those things, and I'll send it to you for free. Um, that's really awesome. Really curious how you end up going. So I think you've been on the comment section before. I believe chatting with you back and forth and things. So always try to reach out to me and keep in touch. But I think I'm gonna call it there, guys. I'm gonna run to the kitchen and grab a bottle of water. I have coconut water here, which is good, but it's not as thirst quenching as bottled water. So if any of you guys have any last final minute questions, let me know in the comment section or in the live chat here. I'm gonna grab a bottle of water and be back in about 20 seconds or so, and we'll see if we have any further questions before I close this thing out. So two quick stories. I got myself a lint. Is this Lindor or is it Lint? I don't even remember. Oh, they're called Lindor. Okay, I was always confused by that. But so quick story on this one. So we have a store in the mall, about half a mile, quarter mile from my apartment, and these are the truffle-filled ones, or the fudge-filled ones, and they're really good. But anyway, so I'm a fiend for like sweets, and so I'm in the store, and it's like an imports store. So obviously, a lot of things on the island are imported because obviously they are able to do things like coconut water, and they actually make some really good crackers and stuff here as well, and bread and stuff are all made on the island, but not absolutely everything is made here, and so instead of making the infrastructure to make it, sometimes it's easier to just import. But other than that, there's one specific shop owner who has made a chain across the country here in Trinidad. I think they have like 3 or 4 stores, maybe more, I don't know. But they basically fill it with things that you can import. And so it's filled with like different types of spices for, say, people from Europe. They have like UK candies. They have American candies that you can't get in a normal store. And you'd be surprised. They have like Mars bars or like M&M bars, M&Ms. They have a lot more than I was expecting of American products and also other products because Nestle distributes a lot of stuff here, and generally speaking, Hershey's and Mars have partnerships with Nestle. So there's that. But so I went into the store, and I'm a sucker for chocolate, yeah. And so I was like, okay, well, I buy these Lints. They're really good, quite expensive, but only 30% premium. I was like, whatever, not a big deal. It's been a while since I've had them. Grab those, and then I was like walking around. I was about to check out, and I was like, huh, chocolate from Ghana. Like, I wonder if that's any good. I was like, it's probably not actually that good. But I was like, the wrapper looks really nice. The wrapper looks really pretty. I was like, I'm going to give it a go. And so come back home, put some of the stuff that I bought at the import store into the fridge. Bought some Haagen-Dazs, which is actually extremely common here in Trinidad, but It is what it is. And then I was like, let me bite into this Ghana chocolate before, I take a shower. And I took 2 little pieces off of it, so it's probably like a 16 little piece bar. Maybe it's like 20-piece bar. 4 across and 5 or 6 wide, or long rather. Took first bite. I was like, maybe it was a bad bite because I was like not feeling it. And then I was like, take the second bite, and I was like, yeah, I just got swindled pretty hard. And it was like, I want to say 35 or 40 TT dollars, which is like, I don't know, $5 or $6 US. And so I was like pretty upset. I was like, I just got swindled because it says Ghana on it. And I was like thinking it might be good, and it was not good. So, moral of the story is, don't buy everything you see because it's imported. It is what it is. But I think I'm going to call it there. So don't know how many of you guys are still on. Probably some of you have already started to sign off because I was getting my water here and kind of winding down. But appreciate you all stopping by. Don't forget to like and subscribe if you haven't already. And I'll talk to you guys on the next video. And a lot of people don't really like the live streams. Actually, if I go to like the analysis or statistics for it, I don't know if I talk garbage or if I say something that offends people. But if I go to some of these videos, I end up losing like 3 subscribers or something like that. Like, we can do a quick check. It's actually kind of funny, but I like doing these, and it kills time. Not to say that like I want to kill time, but I think it allows me to connect with you guys a little bit more. And so, that being said, it's fun. So if I go to live videos per se, and we'll go to, say, this one, and I thought I would be able to do like analytics. Oh, okay, I can. So for this one, let's see. Oh, okay, I didn't lose any on this one. 0 subscribers on this one. But like these first couple, like it was getting pretty bad. Like I had to like laugh. Yeah, so like -2. So like the first couple days, they were like, nah, bro, I don't like this guy's live streams. I got to get out of here before they get worse. And then I think this one was like down to -3 at one point, but let's check. Yeah, -3. So yeah, it was like 1 a day for like the first couple days. So some people don't like them, but it is what it is. Some folks asked, and I also have always kind of wanted to do them, so it is what it is, and that's what got me going. But all right, guys, I'm gonna call it. Pretty cool. Average watch time of around 9 minutes, which is a lot of fun. But really hope you guys enjoyed this. Let me see if there's any last final questions. Good night, Matt. Hey, man, you too. I don't necessarily have a set time where I live stream, but I guess if you guys think I should have like a set time where I live stream once a week or something like that, let me know, and I'm more than happy to do it. I'll leave probably a prompt in the comment section. So if you do like it, just give it a thumbs up, or I'd rather actually you leave a comment and say I prefer you would have X day be a live stream day. So at the moment I'm kind of just doing it sporadically. I was going to make a video, and then I was trying to think of what I wanted, and anyway. But yeah, iterate brand. So I'm trying to think. The money left over. I missed this one. The money left over from your first job buys: AbbVie, EPR, BP, Bank of Nova Scotia, International Paper, K&B, Southern Company, and Chevron. That's awesome. Those are good stocks. One thing I want to make sure is if you see the market going down, don't get discouraged. And for me at least, I continue to buy as much as I can. So that's just my personal view, is I buy generally consistently every single month. or at least put it into my investment account. So when I do see an opportunity, while I might be building cash in my investment account, it's still there, ready for deployment. Even if I don't necessarily invest it that month, it'll be there for the next month or the month thereafter. So, all right, guys, I'll talk to you soon. Really appreciate you guys stopping by. I'll talk to you later. Have a good one.